Good morning, everybody. It is Friday, October 4th, 2019, and we are going to walk through our fourth quarter preview and a bit of a game plan. I am moving towards doing a chart book or PowerPoint every week to make the presentation a little easier to look at and easy to distribute to folks who subscribe to Margin of Safety Investing over at Seeking Alpha, or Fundamental Trends at fundamentaltrends.com. And I'm going to make this available to my clients as well. So what has been going on in the last couple of weeks? Obviously, we had to deal with the impeachment inquiry, and we covered that last week. You can watch that video on YouTube at the Fundamental Trends YouTube channel. So I don't want to dwell on the impeachment proceedings today. I think we all know that there's going to be a battle now. It's probably going to get to the point in the House where the president is impeached. I think that the evidence calls at least for a trial in the Senate. What does the Senate do sometime early next year? I don't know. But the hypothesis that I've grabbed onto is that we will see if 18 or 19 Republican senators decide that it's in their own best interest to vote for the removal of President Donald Trump. I don't know what the answer to that is. I suspect that if the Republicans move against President Trump, it will be swift and it will be decisive. It will not be wishy-washy. So I don't think we'll see 18 or 19 Republicans vote against President Trump in the Senate trial, which is, in my opinion, about 99% likely to happen. We will either see only a handful of people vote against him for political reasons, or we will see most Republican senators vote against him. I don't think there will be an in-between. If it happens, I think it'll be relatively overwhelming. And it will stem from a belief, probably from overwhelming evidence, that the president acted in a way that is inconsistent with the Constitution. Now, whether people want to give him a pass on that or not, I don't think will matter. The senators have to face history, and they have to face their own legacies. And if they can move in a direction together, which gives them shelter, which gives them cover, they will do it. So expect a relatively hard vote in one direction or the other, either most Republicans not voting to remove President Trump or most Republicans voting to remove President Trump, but probably don't expect some sort of close vote. That said, let the games begin. As far as the fourth quarter preview, I have used previews in the past on and off, and I'm going to move in the direction of using them here on out because it gives us a framework to work within. When I was managing money just for my own accounts and for clients, it was easy enough just to keep a little notebook and scribble it out. But now that I'm writing investment letters and trying to help other people, to help middle America take on Wall Street, I want to make this easy to follow, and this will be the first chart book that I put together, and I will do 7, 8, 9, 10 important charts every week in a mini book as well going forward. This booklet I will finish over the weekend, so we will just see kind of the preview here and cover the major points, and then you'll get the full book next week, Monday or Tuesday. So it is important, I think, to have context to what is going on in the big economy. I have talked about the slow growth forever global economy any number of times over the last 6 or 7 years, since I first introduced the concept on Market Watch back in, I think, 2013 or 14. What does the slow growth forever global economy mean? It means very simply that the slow growth in the global economy is structural, not cyclical. The major structure is demographics. but it's also complicated by overwhelming debts around the world and the disinflationary pressures of technology. And what we have discovered in the last couple of years with the trade wars is that we are having some impacts that are negative on the economy because of the trade wars. My argument has been that the trade war with China was probably necessary, but it should have been carried out in a completely different fashion. We should have had our allies lined up with us, not just fighting with everybody in the world. We should have lined up our allies against China, should have had some sort of Trans-Pacific partnership or something, and created a unified front to deal with China and force them to be slightly better actors. Not necessarily good actors, but to nudge them in the right direction. Because moving China off of their approach is going to take a very long time. Or it's going to happen because of revolution, cue Hong Kong. So we will see how fast China moves. President Xi isn't necessarily president for life, despite the law being changed to allow it. He could get forced out. The Communist Party in China, and Michael Bloomberg talked about this week, and he didn't do it well, but the point he was making is that ultimately the people can push back on the government. And at some point, the government, which is the Communist Party in China, will decide what's in their best interest. They may or may not keep President Xi. So we will see. There is always the battle between hardliners and pragmatists in any government. The United States is no exception. We tend to usually drift in the pragmatic direction, but at the moment, that struggle is a little bit more acute. So, where are we in the global economy? As you can see, slow growth has been the name of the game, right around 2%. Historically, we've been up around 3%. And this goes much further back to before the Great Recession. We had GDP growth that was consistently around 3% and sometimes even popped up to 4%. Since Ronald Reagan, since the early 80s, we have rarely seen GDP growth much over 3%. After the Great Recession, we had some big years, but that was a corrective phase to make up for the Great Recession when growth fell off a cliff. And now we're settling into that 2% growth range. We had a couple of years, a few quarters, where the tax cuts caused a sugar high. And now, in the last 3 quarters, down, up, down, we are realizing that the sugar high can't last, just like any sugar high can't last. In the European Union, the problem is more severe. You can see that we have lower lows and lower highs on GDP growth. Their demographics are worse than the United States. Japan is obviously got the worst demographics. They're the oldest population, complicated by not having many resources. So for a value-added economy, they have got to stay at the top of their game because their resources could get more expensive in the future, with one possible exception, and I'll talk about that for a moment later. European deflation, inflation rates for the last decade. Does this tell the story? Does this smell of an ominous deflationary threat? Could this be about to fall off a cliff again? I don't know, but I could see it hovering in this area, flirting with 0. And that could be a problem. In the European Union, they decided to use more monetary stimulus, and a number of bankers jumped all over that, suggesting that monetary stimulus is not the way to go. And during a crisis, monetary stimulus makes sense. It helped save us from a depression a decade ago. However, perpetual monetary stimulus defies the fact that we are in fact in that slow growth forever structural setting. So what do we do to fix the slow growth forever? We'll get to that in just a second. But let's take a look at what's going on in the United States. Manufacturing orders have fallen off a cliff in the last couple of quarters, really this year. This is just a horrible setting. So this was President Trump bragging about the economy, and this is President Trump blaming the Federal Reserve about the economy. As I've said, in a structural environment where you have the slow growth forever setting, will temporary monetary fixes work? No. The Federal Reserve and the other central banks' monetary policies are designed for cyclical problems. Mohamed El-Erian was on Bloomberg today talking about this, and he has echoed, and I have echoed him for the last, 6 or 7 years, that in a structural environment, and Larry Summers is on board with this, Neil Kashkari, Minneapolis Fed, there's a lot of smart people who are saying what I'm saying about the structural changes in the economy. In order to fix these, we have to see fiscal policy. We have to see an infrastructure program. We have to see more of a commitment to education and employee re-education and retraining. So flooding the market with money may drive up asset prices, but it won't necessarily fix what ails the economy. We can only borrow so much to build so many things and create so many zombie companies. Ultimately, we need to have real growth. And that's going to stem from rebuilding the energy system. Again, we'll talk about that in a minute. And water infrastructure in particular. So we will cover a lot of these topics in the next couple of quarters. That is where a lot of our sustainable growth ideas will come from. Payrolls just missed, adding only 136,000 workers. The jobless rate fell to 3.5%. This is indicative of a peaking of the labor cycle. And it is very unlikely that numbers continue to improve on employment with the slowing economy that we just saw from the manufacturing. When ISM falls, generally that is a harbinger of a cyclical slowdown. So what we are likely to see in the next year or two is a cyclical slowdown within the secular trend of slow growth forever. I have talked about a skip straight recession or a straight recession. So a skip straight recession would be a couple of quarters where the economy slows down, but it's not back to back. And the official definition of a recession actually isn't 2 back-to-back negative quarters of GDP growth. The actual definition is whatever the BLS says is a slowdown within the economy. So the likelihood of a slowdown in the economy resulting from trade, resulting from cyclical changes within the secular structure is likely probably by the first quarter. My expectation is that the first quarter of 2020 probably we see GDP growth well below 2%, closing in on zero. A zero print or roughly zero print in the first quarter would be relatively catastrophic to the markets, especially if I am right and the likelihood of a President Trump reelection becomes dimmer and dimmer. Now, I don't want the man to get reelected. I don't really care if he gets impeached. I think the evidence will bear out whatever it bears out. However, the tax breaks are likely to go away in 2021, at least for the 1% and 2%ers. And that means that they'll lock in a lot of their profits. And I think that's actually already going on. And that would pull money out of the market at a large investor level. And we already know that the institutions are in systematic withdrawal because the major institutions are pensions, and the pensions don't have much money going in because pensions are in major drawdown because of the baby boomers taking their money out or getting their payment checks as they reach the appropriate ages, and the younger people not really participating in the pensions, having 401ks instead. So what happens in the next year? If we see an uptick in unemployment, which is quite possible, what do we know? We know that roughly half the people that lose their jobs cash in their 401k plan. That would create forced selling in the market. A number of people, from myself and to people smarter than me and richer than me, Dr. Brewery is somebody we talked about recently, have speculated and really just laid out the math that if there is any sort of forced selling by people losing their jobs or any other reason, if people panic and start to reallocate their money into lower equity positions by selling off SPY and VOO and QQQ and other ETFs and mutual funds, there'd be a spiral effect because those funds have to sell the underlying stocks. So with QQQ, if people started selling that, and it's like the third or fourth most popular ETF, that means that Microsoft and Apple and Google and Amazon and Facebook and the other top stocks would have to get sold. How quickly would people pick up those stocks at bargain prices? My thought is not too quickly, because most people don't buy stocks anymore. Most people buy ETFs. We know that 60 to 70% of retail investor money is going into ETFs now. So we also know that the millennials very heavily favor technology. So they would probably wait. And if they're the ones losing their jobs, which I think is probably likely, they would have to wait before they can reinvest. So if we see a big correction, I'm not necessarily sure that we see a V-shaped recovery. I think it's more like a U-shaped recovery. It takes a little bit of time next time. It probably won't be like 2009, where starting in April of 2009, after 9 months of the market dropping, the market suddenly started going up and gained 50, 60% relatively quickly, I think within 14 months. So we'll have some time to make our selections, to make our stock picks, to make our ETF asset allocations, which is why when we take a look at our very short list, and we take a look at our asset allocation, on the first drop in the market, now we are heavy in cash, okay? The aggressive folks actually have been trading part of this cash. But in general, we're 55, 65% cash. And even on the first level drop in the market, I anticipate, this is an anticipated portfolio, that we still are going to be holding some cash. Why? Because there's probably two legs down in this market. Quarterly GDP we talked about. And this is a chart from a couple of years ago where I showed where the bottom points in the market are. And as the market has gone up, these levels have turned out to be pretty accurate. This is about where we got on the December correction. This is where the major support is, short of a financial crisis. This is where the support is if there is a financial crisis. Now, will we ever see this line again, 1700 on the S&P 500? I think probably. I think at some point, if we don't deal with the structural problems in the economy, this will happen. Now, my opinion is that Elizabeth Warren is probably the most likely to deal with the structural problems of the economy. Joe Biden, he's a middle-of-the-road guy. he'll just try to kind of stabilize things and push things along in a slightly left-handed direction. I don't think that fixes the structural issues. So this, I feel, is pretty much assured, probably by the end of next year. This could be any time. And this is coin flip. Do we solve the structural problems ahead of time, or do we wait for a crisis? Your guess is as good as mine. So what do we want to do as investors? Somebody asked me, would I be investing in our first support level prices on our stocks or looking for bottom fishing? And again, I have to thank Dimitri for scrubbing this up for me, because I have no idea how to write these formulas. When I copy them, I inevitably screw something up and cells don't work. But as you can see, a lot of our stocks are starting, and this doesn't look like a lot, but anytime there's more than 3 or 4 stocks hitting support levels, you know, out of 30-ish, you know, 35, 40 stocks is what we cover here on the dividend growth side. You have to start asking your question, what does it mean when so many stocks are falling below their first support level? It probably means that more will also fall off their support levels. And a lot of these levels, a lot of these stocks are way higher than their bottom fishing prices. And people say, well, Kirk, look, you take a look at a stock like Intel, and you say, it could go down to 30. Intel's not 68, can't drop 68%. Why not? Why not? It was at that price level just a couple of years ago. If we take a look at Intel, which could be damaged by the trade war, it was just 2.5, 3 years ago, it was down in the lower 30s. If you go out to the 5-year chart, it actually dipped well into the 20s for a hot minute, right here. So to think that this stock can't go from here to here is naive. Stocks drop all the time like that. So when we take a look at our companies and somebody asks me, would you be buying the support levels, the more immediate support levels, or would you be waiting for bottom fishing? Here's my answer. If you're a trader, if you fancy yourself somebody who's going to tweak their asset allocation more often, and you have some technical background that you can fall back on, then you may want to trade some of these stocks. And here's why. When you take a look at the daily money flow, so that's this in here, we're in the middle of the market. And what do I say over and over again? Unless you have very good technical skills, avoid the middle of the market, avoid trading it. However, if you were inclined to trade it, you would take a look at the weekly money flows and see that they're closer to the bottom than the top. And you'd also see that the monthly is pretty low. Still can go lower, but it's pretty low. Take a look at it over a longer time frame. Pretty low. What does this mean? Probably with any good news or any lack of bad news, we could probably see a rally in the next few months, maybe through January or February, and get a rally in the stock market. Now, if you're going to trade more often, you could be buying the support levels right now. However, you should have a game plan of getting out of those stocks in the first quarter during that period when retirement plan inflows, right, from corporate plans are in. It's the only time of the year that corporate inflows really matters. Retirement plan inflows really matter, is the first quarter when corporations are making all their contributions and people do their catching up. So that is largely where the January effect comes from, is from the retirement plans. So you could hypothetically trade the shorter term within the bigger, longer term. My guess, it's just a guess, I'm not really willing to wager on it. I'm not willing, me personally, from a risk management standpoint, I'm not going to really put much money in here because I would rather wait for the rally and then sell even more of my stuff. Because my overriding view is that next year is going to be negative. So I'm looking to sell the rips, not buy the dips. Which means I'm probably not buying these first support levels, except on just a couple of stocks, right? On the growth side, if I could buy Amazon at $16.25, I would think about it. I don't know that it's going to get down to $13.80, but I might trade an Amazon. I might trade a Google, right? Those are my A-list stocks. Amazon, Google, these are stocks that you want in your portfolio. Take a look at Micron. Micron suddenly is coming back to us. It gets down to 34. I'd have to take a look at the trade outlook. But probably I want it even a little bit lower, back at that price that we bought it, whatever it was a year ago. Okay. So we traded this once before, made some money, from 30-ish to 40-ish, and I could do that again. The next time I buy Micron, I probably hold it for years. And that's ultimately what I want. I want to own my stocks for years. So my inclination is to look for bottom fishing prices. With so many stocks hitting their support levels, the odds become lower that they hold those support levels. So like I said, if you have very good technical skills and your risk tolerance is high enough, you could trade this 3 or 4 month period, right, to try to buy some dips and then sell them later. With around half, 40% of our money in the stock market, though, I'm really looking to get that down to maybe 20% by January or February if things go the way that I think they're going to go. If suddenly the world is fixed, if there's a magic solution to structural slow growth forever, if all of a sudden everybody in Congress and the presidency decides to play nice, then maybe I go here and increase my equity allocations and decrease my cash. Now, when you look at my asset allocations, excuse me, it is common for me to have around 10% of my money in cash in an aggressive account. And in moderate and conservative accounts, 20%. So even here, through next year, I anticipate having relatively high cash balances because my outlook for next year is not positive. A couple of things that we'll want to understand. The slow growth forever economy, a guy named Ray Dalio, he runs the biggest hedge fund in the world, billionaire, talked about helicopter money and how it might help the U.S. economy break out of this slow growth forever structural problem. This was a few weeks. He talked about it in February 2016. I talked about it about 2 or 3 years before that, but he brought this up again recently. I'm on board with him. I think helicopter money is inevitable. If they do it right, it'll work. If they do it wrong, they'll cause stagflation. We'll see. What other things could happen in this quarter? Well, we're dealing with Brexit. At the moment, despite his rhetoric, apparently there's a letter out there that says that Brexit could get delayed again. We'll see. I don't know. He said that he was going to exit at the end of the month no matter what. I don't know that he can do it legally, and I don't know if the government of the UK will allow it. I suspect that there's still a second referendum coming in the UK. There are monumental problems with the UK leaving the European Union. And if they really truly are committed to leaving the European Union, Johnson should just cut a good enough deal and get out. But what do we know about autocrats who have hard heads when it comes to cutting a good enough deal? Well, take a look at our trade negotiations with China. President Trump could have cut a good enough deal a year and a half ago. But he pushes and pushes and pushes, and then ultimately there's no deal. The same thing could happen here. When you try to get 100% of what you want, very often you get zero. There needs to be some level of compromise, and we'll see if that happens with the trade war. We'll see whether or not that happens with Brexit. We have tariffs going on in the European Union in a couple of weeks. Why? Because they illegally supported Airbus. And I think that's true. However, we support our companies too. We just do it a little bit slicker. And ultimately, all of these trade issues could be dealt with a little bit of negotiation around strategic industries and companies in the various countries. So when you take a look at economics, the laws of comparative advantage, right? Somebody in one country does something better than somebody in another country, but the other country has something they do well, and you trade. So the United States does XYZ well, but Europe does ABC well. Well, we'll focus on XYZ, they'll focus on ABC, and then we'll trade some XYZ for some ABC. That's comparative advantage. Comparative advantage, as we've talked about earlier in other trade calls, is going away. Why? Because a robot is a robot is a robot wherever you put it. So labor costs are flattening out around the world. It'll take a generation or two to really be flat, but it's heading in that direction. And comparative advantage is slowly going away as well. So in the United States, our major advantages are resources and services. We don't really make anything any better than anybody else, some high-end technology and other high-end things, but everything that's in the middle of the markets, all the consumer goods, for the most part, can make this stuff anywhere. We have resources that much of the world doesn't have. We have services that we can offer because of our experience that are major advantages to us. So when we cut trade with other nations, it necessarily cuts the amount of services that we provide, which lowers our GDP yet again. So we need to understand structurally where the economy truly is and what our advantages are here in the United States. So while I'm not exactly an America First guy from the standpoint of rhetorically what that really truly means, I am an American and I want things to go well here. However, you have to have win-win relationships around the world, and right now we don't. So will these things get fixed? Sure they will. Either that or we'll have a big war. I sure hope it doesn't go that way. But probably after the election, things start to move in a better direction if we make some corrective actions on who we have handling things. Now, if we just want to butt heads, if we just want to make a point about, well, I hate those other people, so I'm going to vote for that guy, whatever, you can do that, but there's a bigger picture. And as I wrote in a comment on somebody else's article yesterday, for those of you who support President Trump, I just have one message for you. I've worked for a Republican Party before. I don't look at President Trump as a Republican, and he's certainly not a conservative. So if you have angst against the East Coast, like I do, right, because I think a lot of problems come out of the Washington, D.C. and New York, maybe look for a different solution. I'm deciding right now whether to work for Joe Biden's campaign or Elizabeth Warren's campaign. I think they're both good candidates. I think Elizabeth Warren checks all my boxes. So we'll see. But when you peel out the politics and you look at it pragmatically, don't just vote for somebody because, hey, he's the same kind of angry that I am. At least he pretends to be. Look at the solutions a little bit better. Take a look at what's truly going on out there. Because once you do that, once you step back from the ideology, once you step back from this is how I feel, you take a look at the analytical standpoint, you start to say, well, wouldn't the problems that I'm concerned most about get better with these other solutions? Maybe, maybe not. But it is a way of peeling yourself back, and it applies to how you invest. Because you won't be paralyzed by feelings when the time comes to buy. About 156, I'll show a fundamental chart here. About 156, right in here, is where QQQ gets very attractive. Notice this point, then right in here, that's a support level. Just imagine a line here. Here, I will pop it up. Oops, that didn't do anything. But just draw a line. Look here where it jitterbugged. Kind of got down to that level again a couple times. Jitterbug, goes up, comes back down to that area, goes up, comes back down to the area. We get a rally, comes back down to the area and breaks through, but only for a hot minute, for like a week. And we need 2 weeks of confirmation, right? If this had stayed down here for more than 2 weeks, then it could have gone further. And we've talked about some of those technical indicators. The weekly charts, when they confirm each other back-to-back weeks, that's when you have to really worry if a new level is coming. But it came back up, sniffed it, backed off, and then broke through. So this level here, about 156 on QQQ, I'm really interested in that level. I'd probably be a buyer there. Now, that doesn't mean that it can't go lower, right? Take a look at the 10-year chart. And this is probably where the ultimate support is, right in this area, about 115, 120 on QQQ. So right there, what's that? 119. So right around 120 on QQQ, you could definitely see it come all the way down there. That would be a pretty significant recession. And we could come all the way down here on a financial crisis. I just don't think this is going to happen, but it could. And remember, the companies in QQQ are the ones that are disrupting the economy. And what did Stanley Druckenmiller just say to the New York Economics Club? Buy the disruptors, sell the disrupted. These are the disruptors. And I'm not a big fan of Netflix. Why? Because they just got a whole bunch of competition. I like pretty much everybody else. Even Pepsi I like a little bit. Because I think water is going to become more profitable in the future, and that's horrible that water would become more profitable because we all need it. But I think that they're going to do all right there, and they'll probably start jamming weed into something. So most of these companies are companies you can take a look at. My favorites, I like Apple as a bank substitute. What? A bank substitute? Well, Apple has more money than most banks, virtually no debt, and has no net debt. They have no structural exposure to the economy from the standpoint of bad loans. Granted, their sales can go down. But if you want a bank, don't buy a bank. You can get all the benefits of a bank without the risks by buying Apple. And you get a dividend. Microsoft, same thing. And Microsoft is taking up some new cloud space. Alphabet, I affectionately call Google Bet, is another company. You can buy this one instead of a bank. It doesn't pay a dividend, but if it spins off another corporation and all of a sudden you get stock in another great company, that's sort of a dividend, isn't it? Dividends don't have to be in cash. Dividends get paid out in product. There used to be that Procter & Gamble and other companies would send you a box of detergent. Here's your dividend. Or some other product that they have. They'd send you a free product for being a shareholder. Kind of neat. Google gives you free product all the time, right? Almost everything from Google's free. So don't tell me that they're not providing, improvements in standard of living. You don't have to pay for most stuff that Google gives you. So you go down this list. Cisco, big deal in 5G. Intel, secular trend in memory. I like Micron better. I like NVIDIA better. Right, NVIDIA here. Like to get in on them. Amgen, if you just want biotech, you can buy a basket of these. So what does that mean? Top 20 holdings here is, like 70% of the fund. You just buy this. QQQ, in my opinion, is the core ETF holding that you should have. It's expensive right now. It needs to fall to the 150s for it to be attractive. And I think that's going to happen. The future of energy. I'm going to do a whole presentation on this soon. But as I've suggested, and this is a year later than I thought would happen, shale is starting to flatten out. And that doesn't mean that it's not going to chop along in a range. It will. And it's not at the top of its range right now. Could definitely add another 1 million barrels a day of production by next summer. And I think it will because of the pipes being done in the Permian. But they're going to do it with fewer people and less equipment, which means cheaper. So the cost of oil is going to fall. The production cost of oil is going to fall because of less machines and less people and more efficient machines. However, the oil itself is getting more difficult to grab because they've high graded to the point where the oil that they're going after is a little bit, tougher to get out of the ground. So you have the oil out of the ground getting more expensive, right? Just because it's more difficult to grab. Yeah, but you're doing it with fewer machines and fewer people. It's kind of a weird system where the things will balance out. So the ability of the oil companies to lower their overall costs, right? One cost is going up, one cost is going down, really has pretty much ended. So the oil companies need oil to be in the middle 50s to really turn any type of marginal gains that they can return cash to shareholders. So I would expect that you don't see another boom in oil production anytime soon, because A, everybody's concerned about slowing economic growth. B, shareholders and financial institutions have been pushing back on the oil companies for a couple of years now. C, some of the little guys have gone out of business. D, the really big producers are kind of projecting not until 2022, 23 major increases in production because of their offshore developments. Keep in mind, typically the price of oil goes up a bit under Democrats. Why? Because they want to get rid of it anyway. So if it costs a little bit more, that incentivizes the consumer to switch. So in the 2020s, as the price of electric vehicles comes down, remember, 70% of oil is used in transportation and about 2/3 of that in cars. So 40-50% of oil is used in cars. If in 2021 or 22, it costs $4 a gallon to fill your tank, and an electric vehicle is only $5,000 extra dollars versus the internal combustion engine vehicle, you're going to start doing some math equations. All right, let me take a couple questions here and we'll call it a day. And then I will update this chart. I have a section here on selling cash secured puts. I do think that selling cash secured puts on the dips makes some sense, but I'd be out of the money in short term, the January maybe. So if I expand my equity asset allocation in the short run, I'm just going to sell puts that are pretty out of the money, collect a few percent, and be happy with that. And I would sell down below the support levels. All right. Any thoughts on the real estate market? Yeah, I have talked about the real estate market quite a bit. Way back. Way back in 2010. I told people December of 2010, which was like the exact bottom in the real estate market, it was that quarter. I told folks to go out and buy real estate in 2010. And I said, if you have to cut a deal with people in your family or friends to pool money or borrow money or find a way to do that, you should have bought real estate back in 2010, 11, 12. Folks who are buying real estate now are buying a future problem. Real estate is about as expensive as it can get because you have to compare real estate against the income it takes to pay the rent or mortgage or the revenues that a company generates to pay their rent or mortgage. And what we know is that we have overbuilt certain types of real estate and underbuilt others. And most of the real estate people think about is commercial or residential. We have clearly overbuilt residential rentals, but underbuilt individual homes. We have clearly overbuilt commercial real estate, given that the trend is to work more remotely and have smaller offices. Something to keep in mind, this whole WeWork thing, the whole idea that you can go and share these little pod real estate, offices with people. I've been skeptical of that for a while. Why? Because work isn't a party. And you can talk about networking all you want, but as somebody who's taken executive training, it's not efficient. If you are constantly breaking into your day to talk to other people, your work process suffers. I get way more done being hunkered down in a room by myself than I ever would in an office where people are popping in and out. I can network when I choose to network at other times and other places. Maybe the millennials haven't figured it out yet, but ultimately, WeWork is a problem. Why? Because they've rented a lot of real estate and other companies like them have too. I see most of those failing. WeWork is already headed down the tubes the same way Uber is heading down the tubes. Why? Because they can't turn a profit. And ultimately, they have to shake up the people they're doing business with. So again, real estate risk leads to bank risk, leads to economic risk. You need to be aware that all these things are at some level connected and be careful about the risk that you take. I honestly, truly would not own a single bank, and I don't. And I probably won't ever again. Even after a major crash, do you really want to own the banks when you can own the companies that are going to sell products? The banks just aren't safe. They're never going to lead again. It was different when banks were forming. The financial industry is changing, and the banks aren't on the forefront. JP Morgan is the only one that I even think about investing in the big banks, and I still wouldn't do that. I'd rather buy PayPal. I've been kicking around Square for a while. PayPal, I tell you what, PayPal is one of the few that I would look at buying at the first support level. Corporate buybacks. Yep, they're holding up pretty nicely, and they will through the end of this year. But next year, we're going to see a drop in corporate buybacks. We can already tell because their profits are thinner, and they have less money to do the buybacks with. So, again, when I said earlier that if you want to trade the end of the year, I get it. I don't think it's a low risk trade, but it's a trade that could work. I think we could get a fourth quarter rally. I said that all along, that we could get the end of quantitative tightening rally. But it's something that I would sell into. ARK, ARKK, bottom fishing is 37. I think that's right. Yeah, 37. So I nibbled on it in the low 40s just to have some position. But then 37 is probably a pretty good spot. And I might amend this down a couple dollars. I want to look at the internal holdings, and I really want to do the math on if Tesla dropped to 160, what would this do, right? Because that's 10% of their position. But it's going to be mid-30s probably. Yeah, there's already major defaults happening in real estate. I think these people, and Dividend Sleuth and I, are working on a whole series on real estate investment trusts. So when you're reading some of these guys on Seeking Alpha, who are just what my brother and I, who works at Northern Trust, call bull market managers, right? They're smart when everything's going up because they just throw a dart at the dartboard and then they back in a rationale and say, hey, look, I picked something that went up when everything went up. Big deal. Monkeys do that. So, and they do it pretty well. Monkeys do it pretty well, because they throw darts and they have fun with it. But some of these articles you're reading about REITs are so, to use a presidential word, bullshit, that you better think about selling some of your REIT asset allocation. And remember, the S&P 500 is only 3.5% real estate. So if you have more than 7 or 10% in real estate, you are way, way over allocated. Now, that can make some sense, but what we know is that prior to this asset run up from the quantitative easing and the other monetary stimulus, REITs in real estate have barely outperformed. Just a shade. Most money in real estate is made from redevelopment or remodeling or re-something. Neighborhoods that go from being bad to good over a generation. That's where most money in real estate is made, is buying a property at the edge of a neighborhood that's becoming better, or finding the worst property in a good area and rehabbing it. That's where real estate money is made. Just being a rental guy, just being a slumlord, just being a rent collector, that's always been cyclical. And the smartest landlords I know were selling in 2005, 6, and 7 and buying in 2010, 11, and 12. And you know what they're doing right now? They're selling again. So be careful with real estate. Your REITs aren't as safe as you think. Take a look at the charts from 2007, 8, and 9. That's your risk with the REITs. They can fall 30, 40, 50%. And, some people go, well, I'll just buy more. Well, I guess. But do you want to be down 30, 40, 50%? What does a 6% dividend mean to you then? Look at things as total return, not just the dividend yield. All position sizes for me are under 5% now. I could go as high as 6%, but most positions are 1 or 2%. Very rare that I go more than 1 or 2% anymore. If I'm going to own 20 to 30 stocks, and a couple of them grow, more than I would anticipate, and some of them drop a little bit, if they're all at about 2%, that's half of your money. And then I want some funds for diversification. So a 1 or 2% position is going to be normal. And then some positions you decide I'm going to expand to maybe 3 or 4 or 5, even 6%. What companies would I expand to 3, 4, 5, 6, 7? Not 7. 3, 4, 5, 6%? They'd be the Googles and Amazons of the world. The ones that offer you growth, a great balance sheet, and a huge amount of safety because they're not anywhere near being disrupted. Invesco, which is what a question somebody just asked in a question. I like Invesco. Big fat dividend. It's on the right side of the financial revolutions towards ETFs. They have one of the best ETFs in QQQ, and their factor-based ETFs are pretty good. So I would be looking at BlackRock if it gets cheaper, and Invesco right now is cheap, so you can buy Invesco now when it's in that 16 area. Somebody mentions, oh, this is Dividend Sleuth. During the Great Recession, some REITs were forced to pay their dividends in stock rather than cash. One key factor for me is the amount of REIT leverage, particularly encumbered leverage like mortgages. Absolutely. And with commercial and retail REITs, you need to take a look at, if it's retail, how disruptive excuse me, still getting over that, how disrupted their tenants can become, because the contract is only as good as the checkbook that backs it up. So there can always be renegotiations. I would expect thinning margins for most REITs during the next economic slowdown, which I think is next year. And on the commercial side, you're fighting the big secular trend. And by the way, if all these office sharing things start to contract, all of a sudden you knock 2, 3, 4, 5% out of that market quickly. That drives rents down in general because people start hopping around and renegotiating, but you have empty spaces for a while. There's a spot in downtown Milwaukee that's an awesome spot, and I've been looking at it for 9 months now, and they still haven't rented it. If it's available in the first quarter, and it may or may not be. People don't like to move in the winter, so it might be. If it's still available in the first quarter, I'll give them an offer that's a little lower than what they're asking for and see if they take it. Because I'd love to have a downtown office on the cheap, but I'm not going to pay up for it. Why? Again, there's no marginal improvement for me over where I am, but if my life changes in a little bit of a way that I'm anticipating, then maybe I want an office where I can do some production, and I'll share that office with like 1 or 2 other businesses. So I do my own mini sharing thing, but I do it on the cheap. So you take a look at what's going on around the country, and I just took this 3,000-mile drive, and I'll tell you, it is easy to see that things are slowing down, although consumers really have had great vacations lately. So there is consumer spending that's holding up, but we know that consumer debt has gone up again. So there's going to be a contraction in consumer spending. My guess is in the first quarter, right after Christmas. And we get that down quarter or that zero quarter. So again, I would be selling the RIPs. If we get a dip and you want to sell some cash secured puts out of the money, have at it. There's maybe a handful of stocks I would buy at these support levels, but in general, I'm looking for the bottom fishing. All right, let's call it a weekend. I've got a little bit of poker to play tonight, and my folks are in town throwing their 50th anniversary dinner tomorrow night at Carini's in Shorewood, Wisconsin. If you're ever in the area, take a look at Carini's La Concadera. It is one of the best Italian restaurants around. And if you have any more questions, throw them up in the other chat rooms, and I will get to them. On Monday, I will have an article as well as this chart book ready to go. So have a great weekend. Enjoy what's left of the good weather, and maybe go out for a drive and see the leaves changing colors. Take care.